Welcome to the Deep Dive, your go-to for cutting through the noise and extracting the most important nuggets of knowledge. Today, we're doing a deep dive into Wipro's Q1 FY26 performance, fresh off their recent earnings call and Q&A. We've sifted through all the details, and we're ready to unpack the critical insights for you.
That's right. Our mission today is really to focus on the core numbers, management's take on the current macro environment, and their strategic moves in what's clearly a rapidly evolving market. What we're seeing here right from the start is Wipro grappling with a fascinating dual narrative. You've got short-term revenue headwinds, but also signs of significant long-term strategic wins. We'll be exploring this kind of tension throughout our deep dive today.
Okay, so let's kick things off then with a quick look at the headlines for Wipro's first quarter. That's the one that wrapped up on June 30th, 2025.
Right. So on the top line, IT services revenue landed at $2.59 billion. Now, this represents a degrowth of 2% in constant currency terms. That means excluding the impact of currency fluctuations. Just for a clearer picture of their operational performance, that figure also fell squarely within their guidance range. And sequentially, that was also a 2% decline in constant currency.
But here's where it gets really interesting, I think. Despite that revenue dip, their IT services margin actually expanded. It hit 17.3%. That's an impressive 80 basis point increase year on year. So, 0.8 percentage points for those keeping track. And on the bottom line, net income grew 10.9% year on year. That's even after absorbing a one-time restructuring charge of INR 247 crores.
Right. And just for clarity, a crore is an Indian unit. It's 10 million. So that's 2.47 billion rupees.
Got it. And EPS was also up, growing 10.8% year on year to INR 3.2 per share.
Yeah, so this immediately sparks the question, right? How are they managing margin expansion when the top line, the revenue, is declining? It definitely signals strong internal cost control, operational excellence, that sort of thing. We'll connect this to the broader picture as we go deeper, especially, I think, when we look at their strategic deals and some of the efficiencies they're getting, maybe from AI.
Absolutely. Let's dig into that revenue picture by geography then. Americas 1, for example, grew 5.8% year on year in constant currency. Seems like strong deal momentum there. Americas 2 also saw sequential growth, 1.7%. AMI was, flat year on year.
Okay.
But Europe continued to face pretty significant headwinds, declining 11.6% year on year.
Wow. Yeah, that's quite a drop.
And Capco, their consulting arm, that grew 6.1% year on year, mainly driven by Latin America, apparently.
Interesting. Okay, so from a sector standpoint, BFSI, that's banking, financial services, and insurance, that saw a decline. But management made a point of noting strong underlying demand for modernization projects within that sector, even if the headline number was down. Okay, healthcare performed well, growing 3.5% year on year. However, consumer manufacturing and resources faced a much more cautious environment. Seems like they were directly impacted by ongoing tariffs.
Right, those tariffs keep coming up.
Yeah. And technology and communications, on the other hand, showed a pretty clear shift towards AI investments.
So beyond the top and bottom lines, their cash position, that tells another crucial part of the story, doesn't it?
Definitely.
Free cash flow as a percentage of net income was pretty robust at 115% for the quarter. That brought their gross cash to a healthy $6.4 billion. And the board declared an interim dividend of rupees 5 per share. That's part of a larger distribution of over $1.3 billion to shareholders in just the last 6 months.
Yeah, and this aligns with their revised capital allocation policy, right? To pay out a minimum of 70% of net income over a 3-year block. And they're trying to pay dividends twice a year now.
So that strong cash position gives them crucial flexibility, especially in this, still uncertain macro environment.
Exactly. And what management emphasized was that while, geopolitics and tariffs continue to impact certain sectors like retail, CPG, manufacturing, they've adapted quietly. Their focus on cost optimization and vendor consolidation is proving to be a key driver for winning new business right now.
Okay. And that brings us directly to their deal wins. This is where that long-term narrative really starts to take shape, I think.
Yeah, this is the big number.
Wipro reported total contract value, or TCV, bookings of $5 billion. That's a substantial 51% growth year on year.
51%. Yeah.
And even more impressively, large deal bookings surged an incredible 131% year on year to $2.7 billion.
Wow.
They closed 16 large deals this quarter, including 2 mega deals. And many were explicitly driven by that trend you just mentioned, vendor consolidation.
Right. And what's truly fascinating about these deals is, their nature and what they represent. Wipro shared 3 concrete examples. There is a global banking leader choosing them for a comprehensive tech transformation, a leading global semiconductor company signing a multi-year agreement for product lifecycle modernization, and another mega deal with a North American bank, extending a partnership that's already lasted a decade. All 3 of these really highlight a clear and accelerating trend. AI is moving from being kind of a niche experimental thing to an essential core part of client solutions.
So how exactly are they integrating AI into their own operations then?
Well, Wipro is clearly building what they call an AI-first, AI-everywhere enterprise. They seem focused on leveraging AI to solve complex challenges, accelerate delivery, and just reimagine operations at scale. They mentioned embracing autonomous and agentic AI.
Agentic AI. So like AI systems that can make decisions and act on their own.
Sort of, yeah, to achieve specific goals. They've already deployed over 200 AI-powered agents using leading hyperscalers, the big cloud providers like AWS, Azure, Google Cloud. And this is enabling things like smarter lending processes, more intelligent claims processing, stuff like that.
Okay, so this AI integration, it must raise questions about how it impacts their business model, right?
It does. And management noted that these AI-driven efficiencies, especially in areas like the software development lifecycle, they are influencing pricing on projects. This is particularly true in those really intensely fought vendor consolidation deals where maybe some of the AI-driven benefits get passed on to the client.
I see. Competitive pressure.
Exactly. And while AI talent still commands a premium, Wipro is also heavily focused on in-house training, building these capabilities internally.
Right. Well, of course, none of this strategic stuff, the AI integration, happens without the right people. What's the picture on the talent front?
Yeah, good question. The company mentioned that overall attrition has been relatively flat. It's hovering around 15% over the last few quarters, though they did acknowledge pockets of higher attrition for specific really in-demand skills.
Makes sense.
So they're strategically moving high-potential talent into critical roles and encouraging, lateral rotations for leaders. This non-linearity they talked about between revenue and headcount change is basically, revenue growing without needing proportionally more people. That's partly driven by AI efficiencies. And they expect that to be the new normal.
Interesting. So what's their hiring outlook?
For FY26, they aim to induct around 10,000 freshers, but overall hiring, they said, will remain quite demand-specific, so not just hiring for hiring's sake.
Got it. Okay, so what does all this mean for the next quarter, the guidance?
Right, the guidance. For Q2 FY26, Wipro is guiding their IT services revenue to be in the range of $2.56 billion to $2.612 billion. This translates to a sequential constant currency guidance of minus 1.0% to plus 1.0%. So pretty flat, basically.
Okay. Flat guidance sequentially.
Yeah. And management stated that while they remain cautious about the macro environment, their strong order book, that healthy pipeline we talked about, and their focus on AI-powered solutions, that does give them confidence. They explicitly said that the second half of the year looks far more positive and performance should get better.
Driven by those large deals they booked, I assume.
Exactly, driven by those large deals, despite, typical seasonality. But it's worth noting, as they pointed out, these large deals can take a significant amount of time, they said 6 to 8 quarters, to fully ramp up and really show up in the revenue figures.
6 to 8 quarters, okay, that's quite a lag time.
It is. Patience is needed there.
So as you can clearly see, this is a company navigating a pretty complex macro environment, but leaning heavily into these big strategic shifts. The strength in their bookings, particularly those massive large deals, it really demonstrates their ability to win significant business, even in this cost-conscious, vendor-consolidating market.
Yeah, it just reinforces that dual narrative we discussed at the start, doesn't it? You've got this near-term revenue degrowth as they transition, maybe some lumpiness, but then there's this significant long-term potential bubbling up from these large, often AI-driven contracts.
Right.
The challenge ahead, though, will undoubtedly be the execution, the precise execution and successful ramp-up of these multi-quarter deals. That's key.
And their strong free cash flow and that commitment to shareholder returns via dividends, that kind of underscores their financial discipline, wouldn't you say, even during this transition?
Absolutely. It's a clear signal, I think, of management's confidence in their underlying business model and their future cash generation potential.
All right, this is the part of our deep dive where we play armchair hedge fund analysts. And remember, folks, this is purely for entertainment. It should not be taken as financial advice.
Seriously. Absolutely not. Just spitballing here. So, given Vipro's current state, revenue declining now, but this absolute surge in large deal bookings, heavy emphasis on AI and management, hinting at a stronger second half, but also acknowledging that long ramp-up period for these deals, here's an outrageous but plausible trade idea for you to consider.
Okay, let's hear it. Outrageous but plausible.
Imagine a long-term AI transformation play.
Right.
The market, maybe it's overly focused on the immediate revenue degrowth, right? And the flat to negative Q2 guidance.
Okay.
But Wipro just booked $5 billion in TCV with $2.7 billion in large deals, many of them vendor consolidation, AI-centric. And remember, those deals take 6 to 8 quarters to fully ramp.
Yeah, that lag is key to this idea.
So the outrageous part is, well, buying a company whose revenue is currently declining, that feels counterintuitive.
Definitely.
But the plausible part is that you're betting on the compounding effect of these massive multi-year AI and vendor consolidation deals kicking in later. So one could consider buying long-dated call options, say 18 to 24 months out, give it time.
A longer-term bet.
Exactly. It would be a patient bet that the market eventually prices in the full value of these long-term contracts and the whole AI first, AI everywhere strategy. You're betting the stock gets pushed significantly higher when that revenue finally ramps and the benefits of those, 200 plus AI agents fully materialize.
So it's a conviction play on delayed gratification, essentially.
Wow.
Betting on the payoff from large-scale digital transformation down the road.
Precisely. Outrageous now, maybe plausible later.
Okay, so just to recap our deep dive then. Wipro is navigating a challenging macro environment, making strategic wins in vendor consolidation and really going all in on AI. They've secured substantial long-term bookings, even though they're facing these near-term revenue pressures.
Yeah, and their strong cash generation, that disciplined shareholder return policy, it reflects a pretty steady approach in uncertain times.
So the key takeaway for you, the listener, is really that inherent tension, right, between their present top-line struggles and the clear future promise baked into that robust, large deal pipeline. Especially as AI becomes an increasingly core part of their client solutions.
Exactly. Watch that space. Watch the execution on those large deals.
Well, we hope this deep dive into Wipro's Q1 earnings has given you some valuable insights and perhaps even sparked a few more questions of your own.
Yeah, we love hearing from you and what you'd like us to explore next. Feel free to reach out with your feedback or topics you want to see us deep dive into.
Definitely. Until next time, stay well informed and keep digging for those nuggets of knowledge.